Hi, this is Randy Finney with Right Side of the Chart, and this is video number 2 in wake of the FOMC announcement today. It is 3:12 Eastern Time as I'm starting the video, so a little less than an hour to go before the close. And this will be the everything else video. In the first video, I covered I did a very brief one, got out under 10 minutes. Entire video, and it was just about the market's very near-term outlook, levels to watch today. And again, a reminder, we're still in the wake of the FOMC announcement, post-FOMC noise. So either stand aside if you don't know what you're doing, or if you don't, aren't a nimble trader, or and then just wait to see which direction the market chooses from here, or don't get married to your bias, whichever way you think it's going. I'm going to show you again key levels. It's not to oversimplify it, but there's some big levels to watch, and so I'm going to cover. I didn't cover anything but the Nasdaq 100 in the last video, so let me cover a few things here. This is SPY, the S&P 500 daily chart here we're looking at, and you have the divergence. You had a positive divergence there, and you can see it gave us a big rally. You had positive divergence right there. And that's that line, gave us that big rally there. And now we have positive divergence. What you see is I color coded this. You have a purple line right here that's really the RSI divergence that comes all the way from back there. Then you have the white line here, which is your PPO divergence. So again, and that's a big if the market can turn up here and rally and backfill that gap, and especially head on up to the next one below, it's going to put in positive divergence on the RSI there, or the PPO I should say. If not, it still has the potential for divergence, but I'd just drag this line down here. We're probably going to then do that scenario I talked about, make a run down, hit those second and next targets on the weekly chart, and then maybe go up. So again, it's still, I maintain as of now. And I'll tell you one thing, since I did that last video, so far there wasn't a lot of follow-up buying as I got in the gap. I boxed the gaps in here. When you trade gaps, you can I'll either use either the very high part of that candle on the gap. So there's our previous candle. We closed at the lows that day, so that's a clear level, the top of the gap. But sometimes I'll use the top of the candle. In this case, there was a little wick on top, aka shadow, the skinny part, or you can use the body. And so either way, if either one you use, we popped into it on SPY, but so far fell back out. Remember, I talked about this in the video. It's usually once a gap's entered, it's backfilled. But we only had a marginal, ever so slight, brief post-FOMC pop into it. So right now, I'm not as crazy the fact that we didn't, keep going and there's no follow-up buyers when we entered the gap there on SPY. QQQ, same thing. See, I had the box before at the top of that candlestick there, the little skinny part, the wick. We popped and we got halfway into it, and now boom, we fell back down above it. I'm sorry, just below it. You can see that candlestick. It was still green on the day, but not ideal. We can call it a break into, and maybe they're back testing. This is where the dip buyers should step in. Anyone that missed the initial, if they don't, then we'll probably break down that level. Remember, I gave you the levels to watch on NQ, where at least my plan is reversed from long to short. This is the top of the gap. If hit, that level is, I'll give you the crosshairs, 289. Then you have a candle there, and then the top of the bottom of the next gap up. Again, whether you're looking at the candlestick body, which is about 293.83, or the wick, up top is about 295. So that would be your next stop there, and then the very top of that gap comes in around 300. And remember, that's also going to come in just shy. A lot of eyes are going to be on this trading range. That was very significant when we had that breakdown, because it led to this, series of those big gaps right there. Okay, so those are and remain potential bounce targets. And if we can't get into this gap and backfill this gap today, if we fall back below the levels I gave you earlier, if you happen to miss that video, here it is. NQ, this is a 60-minute, nope, this is a 5-minute chart. I zoomed in real tight here. Let me go back to the 60 I gave you before in the video. All right, that's the 60-minute chart, and I'll tighten it up. That's 1 month, but really need to just focus right here. Well, I'm going to leave it right here, because remember, we had this big previous reaction low, which as of now we've gained. Bullish until unless that fails. So there's that level right there. Uptrend line and the big 11,533-ish level right there. Okay, let's not spend any more time there. Potential max bounce target this time is also, again, as I covered in the last video, the bottom of that trading range around 12,452 right there. Crap out today or tomorrow. Well, you know my scenario, I already laid it out in the last video. We take another leg down, hit those targets, and then maybe look to go long there again if the charts confirm. All right, so everything else other than the NASDAQ 100, which I covered in the last video, I just gave you SPY, told you the divergence is potential still at this point, not confirmed. And you also have similar gaps to target there. You even have a potential downtrend line. So max, let's just say as of now, max targets there, the bottom of that trading range. That's about 407. Then you have a downtrend line. So first things first, we'll know after today, and I'll talk more on trying to zero in on which target or targets to take profits on if we can hold and build on today's gains. It's that simple. IWM, small caps, trading the small caps. They have also nice positive divergence on the daily chart. Positive divergence on the daily chart is typically, leads to trend reversals, tradable trends that can last months, usually measured in months. It's a bear market, so maybe that happens, maybe it doesn't. Maybe these divergences don't even materialize. Remember, they're potential. We don't even have a bullish crossover. We need a higher crossover, a bullish cross on the PPO that's higher than this peak low or trough low right here. We need another trough put in. All right, otherwise we crap out today. Will probably be a swift move down too, by the way. You don't want to stay short too long if they can't hold today's gains. If they wipe out all today's gains, oof, yeah, you don't want to be long in my opinion. All right, so that's IWM. And remember, on the weekly, small caps holding up. They hit my second target all the way back here well over a month ago. Tested it, rallied up to the bounce target right there, the first target. 192.15 plus the downtrend line. That is not a line tool. This is a line tool. Boom, boom. And now here, simple stuff. Take out the recent lows. You're going to go to T3. So will the market SPY and QQQ to my next targets. Otherwise, we may mount another bounce here. Like I said, I expect this bear market to be a lot different from the 2008 bear market. So we had some analogs that I pointed out early on, and they played out right, especially that second test of the 200-day moving averages, followed by a big leg down. So we nailed that. However, at this point, I'm going to start to move away or take the analogs and going forward with a little more grain of salt, because we were in a much different environment, fundamentally much different. Okay, that's the indexes. The other things I wanted to tell you about is I bought some bonds today from back, first time in a while. I re-entered. Remember I told you back here we traded, game to bounce, and that was it. And then I got out before, when was it? Before I went on vacation. Planned to get back in and never did. Just nothing really was, nothing was compelling enough. Bonds again, they're not going to move much. But I like them today. I'll tell you why, because I've talked about it from a fundamental perspective. Okay, the Fed now gave us another 3/4 point rate hike. The economy is slowing. Every metric, consumer spending just came in. That was soft. Consumer spending's going down. So what we have is hyperinflation in a stagnant or a slowing growth environment. You can't really call it. They won't call it a recession yet. Typically, it's not yet. Officially, it's not yet. But we know that economic indicators, the economy seems to be certainly cooling down, if not outright rolling over. Well, the time will tell whether it rolls over or not. But again, it doesn't matter. A slowing economy. Remember, stagflation, the stag part is stagnant growth. It doesn't have to be, maybe by technical definition, I don't know if you have to be in a recession, but I think it's just really a low growth environment with high inflation. And that's what we're looking at. So where am I going with that? Okay, high inflation. Randy, that means interest rates go up. No. Not necessarily, because the bond traders, they've already priced in a lot of that. Remember, bonds move inversely to interest rates, bond prices. So TLT has been falling, the 30-year bond, the long bond here, because interest rates over that same time proportionally have been rising. That's the one certainty. There are a lot of relationships I give you over the years, gold and the US dollar and crude oil and things like that, but they don't have, sometimes the relationship there that is typically a positive or inverse correlation can disconnect for periods of time. There are longer term trends, but there is the relationship between interest rates and bond prices is immutable. It is a direct inverse correlation, and so therefore, if traders now suspect, because of these rate hikes that we've had and are going to continue to have until unless inflation starts to slow down, and remember, even if it went down to zero, that's the rate of inflation, the rate of prices increasing. We've already ratcheted up huge gains that are not that even again, if inflation froze today for the next year, the majority of Americans unfortunately are towards more the end of the have-nots than the haves. We all know that. And so the haves, meaning people of well means, they can tolerate $6 gas. They can tolerate I don't even know what milk is. I don't do the shopping, but let's say it's $5 a gallon, $4, whatever it is. But then the have-nots can't, and there's a lot more of those. And they also, even though they don't buy high-end things, they buy a lot more of little things. So you're going to see sales, retail sales, Walmart, things like that go down. Where am I going with that? Well, that then means slowing economic growth. And therefore that would mean long end of the bonds, long end rates, especially if they believe that the Fed's going to finally at least slow the rate or stall out inflation. Then what you can see are long-term rates start to drop, and that will mean a rally in bonds. Now, again, to me, it's all about technicals. Okay, I just rambled on fundamental reasons why we go. I've said the same thing before, and it started to materialize. We had one more leg down, but here it is. We had at that point a divergent low, and that's where the last long trade I had on bonds, and that divergence is now even larger. Okay, that's big divergence there, and PPO look like it's starting to curl up here. You got a big old gap to be backfilled, so at bare minimum, I'll just lay it out. There's my minimum target right there, 113, a little over. That's about a 3% rally in ZB. If you're saying right now, Randy, why am I going to waste my time on 3%? Well, you buy futures. I do. They're leveraged, so you can make thousands of dollars. Depends how much how many contracts of ZB or ZN you buy, the 10 or 30-year bonds. But you're going to make enough money to make it worth your while, and you can take that leverage because there's just downside risk. And there's also a beautiful trend line there. So it's a great initial target. And then if that breaks out, remember, if we get up there and we have a reaction, which we probably would, but that PPO is going to start turnover, confirm the divergence. Then you look for a breakout, and then we rally up to that next target there, about 118.50. All right? Who knows? Maybe even more. Long term, TYX is the interest rate of the 30-year bond. We were just looking at the ETF, which shows the price. And here's a long-term. We'll go to the monthly chart here. The longest term rate right here. There's that secular the downtrend line of the secular bear market, and there's a breakout. But you can see here, and I'm gonna brighten this one up a little. I had an alternative downtrend line coming in here, and I need to color it up so you can see it well. Make it purple. Make it a little thicker. In that one, we're just about on, because that one, you had hyperinflation there, Carter going out of office, Reagan coming in, then inflation kind of abated. So this is my alternative trend line right there, and you can see we're at that right now. And it's a line I've had on the chart for a long, long time. So that shows you the long bond, 30-year bond, or the rates at downtrend line resistance, while over I have two levels to me that are significant. The highest line is a 70 level. I'll tell you what, you've never seen in some of the people listen to my voice even in your lifetime, but many of you, we haven't seen in decades the 30-year Treasury 30-year yield on 30-year bond hit the 70 level. That's why I had a yellow line at 57.72. I say always modify the RSI based on each individual security. Default charting programs are always going to give you 70 is overbought and 30 is oversold, right? But the only time we were overbought, last time we were overbought, was in the late 70s and early 80s when we had runaway hyperinflation at comparable levels that we have today. So interest rates were a lot higher back then, right? But that was it. So there it is. So, even in the secular bear market, you never got all the way up there. You hit the yellow line little bit above there. I could probably even move that yellow line higher now, and I'll do that. And it just shows you those were that's what capped it before throughout the bear market in interest rates, which again, remember, at the same time was a bull market in bond prices in the 30-year bond. Now this was a major bottom, major inflection point, and I do believe over time this breaks out and we begin a new secular bull market in rates. But that's a long-term chart, monthly chart. You can't nail the entries and exits off that. That's where we use the daily chart, which I'm doing right here. And that's let's go back to TLT. And so you have my targets, right? And then 60-minute chart. Let me show you futures. There's what it looks like on the 60-minute chart of TLT. And I'm going to give you some alternative trading proxies for those of you that don't trade futures but still want a little bit of a juice. So if that minimum target's hit, instead of making 3, you can make 6% by going with USB, I think it is, or UST. No, UBT is it says 20 plus, but they're really targeting the 30-year bond. They hold bond, they'll roll them out if they get less than 20 years. So it really targets the long bond. And this is TLT on juice right here. So instead of getting 3%, if that gap is backfilled, you get about 7, 6-7% right there, about 7. And same downtrend line, same chart, and you don't have as much decay because bonds aren't as volatile. So there's your targets on UBT. And remember, if we break out of that downtrend line, then that opens the door for a much bigger move in Treasury bonds. So that's a trade idea for you. Of course, you can use a little same amount of leverage but less volatility. In the 10-year UST is the juiced up, meaning 2-time leveraged 10-year Treasury bond ETF. As is, and if you want it without the leverage, that's IEF. And same story. There's that divergent low in the trade I pointed out last time. Got that trade, told you I got out, and was looking to re-enter, but didn't have any reason to do so until today. And this time I might stick around longer. Look at that nice big divergent low, nice big gap to backfill. And so me likes treasuries at this point in time as a swing trade. And let's just say, unless the take out these lows or anything changes in the chart, I'm not even looking to take profits until at least that first target's hit there. Finally, let me give you the for you futures traders, ZB. This is a 3-month chart. 3-month chart has 2 divergent lows that again, these charts, I don't know where my lines just went. I did something and all the lines went away. Let me center this chart for you real quick. There they are. They came back. This is what I'm looking at, just to kind of time entries here. 60-minute chart, just like we had back here, and I think that was that last trade I pointed out and we took there, the 60-minute chart. Divergent low, and it was good for a rally of about almost 6%. And this time, because of the bigger divergences on the daily, remember this is a 60-minute chart, you don't see the daily divergences here. I'd be looking at more than that. Was a potential trend line there. Yeah, that's it. Just want to show you coming off a divergent low and targets here. Here you go. If you want a first target right now, I'm just eyeballing some really nice resistance where you're likely to get a reaction. That is at 136.80. All right, and that would give you futures traders a pop of about 2.5%. So roughly the 3 I just said on TLT. I'm going to take this trend line. I'm going to tweak that because we have that reaction high, and I think that's where it would come in right there. And you can see how the trend line also comes in with that price resistance. So there's your trading op for those of you interested in treasuries. And it's also a way to diversify as well. It's a completely different asset class from stocks. What else do I like? Speaking of stocks, I'm just going to revisit ZM. Amazon, as I told you I would beforehand, early on when I took the trade and did it at the time, I took profits at T2. That's where, even though I laid out a third potential target, I'm still liking it. At this point, I may re-enter. The only one I held through all this in my longer-term accounts is Zoom. I gave you Zoom back then as well. So there's Amazon. It's got another divergent low. It could go again. And then if it does, it could easily work its way up to that third target. So again, guys, I'm either going to be right or wrong. And here's the thing about trading. It's not hard. you see a triple bottom support, good support, positive divergence, you go long and you put a stop a little bit below it. A little bit depends on, and yeah, sometimes they're going to run your stop and you're going to be frustrated because it goes back up. So if they clip your stop, but then you see it regain and you have more divergence here, let's say you get a marginal new low, the market's hit support, you can always jump back in. So, I used to get frustrated, when my stops were clipped, and now no big deal, because if the charts firm up, yeah, they got me a little bit there, and I jump back in, and then, so I might have lost 2-3%, whatever the number is, and then to make another 25%. But go back to Zoom all along has just been strong. It was the first individual stock I laid out in a while. Laid it out right as the market was bottoming. I forget where exactly the point was, but we hit my first target. It was a 20-something% gain to that first target from where I laid it out, if I recall correctly, or close to it at least. And look at that, we hit the first target, and this is what I talk about. Why I list multiple targets. Each level is where a reaction's like it. This reaction came despite that big drop we just had in the last week or so in the stock market with that gap, those big gaps. Zoom held up relatively well. In other words, there's two ways a stock can correct. I always say this, or a combination thereof. A stock can correct in price, which is what most people think of as a correction, or they can correct in time by consolidating sideways before the next leg up. And sometimes a little of both. But this was mostly a sideways correction in time, which is the more bullish of the two. It just shows they're strong holders of the stock. They didn't want to let it go. Minimal profit taking and a lot of buyers stepping in even when the market was falling. And now, look, we're coming back up to that level, and it's simple stuff, right? Coiled spring. Pop the recent highs. We're going to go up to T2. And then quite likely possibly T3, maybe even more. This was one of the, it was the first one I laid out. Really nice looking chart. I like this one. Weekly, you can't go back that far because it hasn't been around that long. And, you still have the other ones. If you did what I did, got out at T2 on Amazon. This is the daily chart here. There it is. You can see that nice bottom forming. And hey, if the market does take another jog down soon, which I'm still very much open to, I will be looking to re-enter this one among others. Remember, when the market bottoms, when the big bottom comes, whether it's here today, possibly, like I said, there's still 20% chance of that as of yesterday, and today I'm maintaining that. There's going to be, this is where money's going to come back into. You want to chase junk stocks at top of a frothy bull market. That's when low quality stocks do well. But when people are going to flock to the beat down market leaders. So that's where you want to, QQQ. Just keep it simple. Trade the Qs. All right. Other ideas for you. I told you I'd cover everything else. I covered Treasury bonds, Zoom, Amazon, a couple individual stocks. Let's just do crude oil and natural gas, and we'll wrap it up here. Let's start with the UNG chart for natural gas. Series of divergent highs. 1, 2, 3, meaning we had a divergent high with a correction. We put in a new high, but the same divergence is extended, correction 2, and now our third high. And like I said, when we started going down, you'd probably see even bigger correction because it was an even bigger divergent high. That's usually what happens. Well, not always, but usually. The bigger the divergence, the bigger the ensuing trend change. That's a level I've had a target for a while, 25.58, and we had that move down. And like I said, we're still potentially flagging here on the daily chart. You had an impulsive leg down here, followed by this level of consolidation, which is right back to resistance. We had popped this morning. I added to my natural gas, and luckily it was near the highs. So far, we'll see. It's still up today, up pretty good, as a matter of fact. But there again, when I latch on to something that it looks like there's a pretty good chance there's a major top and a lot of I'll pretty aggressively short the rips. That's what you want to do. It's like in a bull trend, you buy pullbacks, buy the dips, and in a downtrend, you short the rips, right? You short breaks of support like 25.54, or bounces back to resistance, or any other level there. Or sometimes for the sake from natural gas this morning, just because it was up 5-6% at the time. That's a pretty high number, and intraday charts confirm add some money to that short. 24.54 remains my preferred and minimum swing target at this point in time. That still, if hit, would give us another 12% down, and we may overshoot it and hit this trend line. And if things get really ugly there, but that's what I'm eyeing right now. And that is the ETN if you don't trade futures. But if you do trade futures, then let me park the volume here. I was checking volume on today's move. Then NG is your contract, or the QG is the mini or micro. I think mini contract trades at the same price level. So there's our drop. Flag's getting a little long in the tooth, but again, that's just here's what's happened lately. We've been pushing up, making a series of higher highs and divergent highs, like I showed you on the daily chart. Especially divergence has been building, right? Finally, we're starting to get what's becoming more and more apparent, or more and more clear, hopefully, to the masses. I try to think like everyone else is thinking, because the majority of people are bullish on natural gas and afraid to short it. I think they're going to wait till Russia and Ukraine kiss and make up. I don't know, but the chart's telling me right now that, hey, this, up all along, it's volatile, and that was a big drop there, but right now we have the early makings of a downtrend, which is a series of lower highs and lower lows. So whether we come up a little more, if we do, that's a more objective shorting up, especially big level. If you want to aren't in this, or you are in it and you want to know where to add at a high probability level, I think kiss back to this level, bounce back to about 7, almost at the $8 level. It's big. It was big support. Was resistance, support there, support, and then we took it out impulsively. But the reason I shorted today, and I'll have more power to short if I want to, if it gets there, but all eyes are going to be watching that, and it's almost too easy. And we're just below this level. I have a resistance level there, and so that's why I took a short. And I don't wait for a full bounce back. If I think it could bounce back to $8, I'm going to be shorting at $7.92 or $7.94 because all eyes are watching 8. And if I sit there and try to get greedy and nail the exit or entry at $8, a bounce back to $8, well, a bunch of people like me step in early. I'm just going to miss that, and then what happens when it turns pretty quick. So that's why I like to short a little bit below the resistance level that I think may cap a bounce back rally. All right, and then finally there's crude oil, CL, or you can use USO here. I'll give you, because I try to remember not everybody uses futures, so USO, which is the main crude oil ETN, the one I've always tracked for years, very liquid, does a good job of tracking crude oil, and just a beautiful looking chart here on the daily. You've got a big divergent high, i.e. negative divergence. Prices are making higher highs while the indicators are making lower lows, and we just now have upon us a bearish PPO crossover, which finally confirms that divergent high. All along it's been potential. It was potential divergence here, it was potential, but when you get the bearish crossover, plus remember, even if you had confirmed divergence, that's still not a sell signal. It just helps to firm up that divergence, but then you wait for the sell signal, which is, or was in this case, a break of the uptrend line. And if you miss the breakdown, then you shorted the back test. And there it is. There's my first target right there, next trend line. We bounce there, cover the short, 82.32 plus the uptrend line, and then if and when that goes, the potential for a much longer trade. But as of now, here's your downside, another 5% or so. And then if you trade futures, there's a level to watch to break if you want to wait for a break of support. 117. This is a 10-minute chart I just jumped to. Break of 117 should spark a wave of selling. But if I go to a 3-month chart here, and then you've got, we hit my T2 zone perfectly today. So there's a 60-minute chart with the targets I laid out for you. Remember, these just rolled. We're on the Julys now, so that's why I told you I tweaked the. Was it this one? Yeah, I think so. Tweak the targets here. My apologies, that's not true. I rolled to the August. This is the July right here. But either way, that was, so this was the original chart I gave you here. We had a short breakdown, back test, and another divergent high. secondary sell signal, short break that trend line, hit the first target, bounced as expected there, went down as expected, hit T2 today. And remember, these they stop trading in a couple days here, so you should be in. This is what I'm about to pull up for you. The August contract. The only thing I did different, I think I shrunk T2 from a zone down to a hard level, and then maybe added something. I covered that with you yesterday. Here it is. There's the August contract. So there it is. Boom. Perfect tag at T2. Keep it simple. No range. Hard number. 112.65. Hit it today. And this is a zone right there. 106.68 down up to about 110.16 is my next target zone. And as I told you, break of that, what was it? I said on the 10-minute chart, a break of 112, because that's where using multiple time frames can help you hone in on your entries and exits. So that was a 60-minute chart, and that line looks like where it should be based on these reactions. But when I go back to that 10-minute chart I was just on, that might have been on the July. Yeah, that was on the July contracts, but it will be the same thing. You'll see that level I just showed you, which was I think about 112. Maybe it was 113. Remember, the prices are different on the Julys and August. That's why I had to change them and tweak them every time these futures roll. So there it is. So far, looking good. I mean, this is what you want to see. Break of that bearish rising wedge pattern right there. Break back test, impulsive move down. Whether we bounce here or not, that's the next target zone. I added. Oh, this is what I added yesterday. A new potential target zone there at about 106.42. And I still have I'm still maintaining this final target here, this uptrend line, and the which is T4 in roughly the 101-ish level right now. Okay, that's it. Those are the things I'm watching, the main stuff. You know what? I'll do an update on gold and silver the next time around. Gosh, and I promised somebody to do an update of the put to call ratio. Let me pull that up now since I said I would. Okay, there's several out there, put to call ratios. There's this one, which is the total put to call ratio, and you can see there's pretty simple stuff. I have a green a line here at about 153, and that's my time to cover shorts and go long, but wait for, notice how I said wait for a buy signal. But once you get there, that's typically, and they're all down here, shows when the just like when COVID hit. This was COVID right there. You would have bought that spike. It was a single spike. This is a daily. In the fourth quarter, these were the two biggest drops up until this one here, which we called all of these. That was COVID, the 36% drop, and the big Q4 2018 drop. Both of those, look at that. And so what I'm getting at here is now those weren't, well, yeah, you could call that a bear market, sure. That one, no. But you can see that, his bearish as some of these folks finally coming on TV, the Johnny come latelys to the whole thing, those same folks that were all out bullish 3 months ago telling you to buy the dip, high price targets that are finally starting to turn around. They haven't turned around enough. This is where I'll be looking, this plus buy signals to start positioning for some long-term, trend trades on the long side that can last months or more. So we're not there yet, and we're still in swing trading mode. There's still, I still favor more downside. And likewise on the bottom, I have when you hit down here on the red line, this is my extreme complacency, wait for sell signals to short or go long. And I talk about clusters. We had these clusters. We had excessive complacency leading up to the top there, and there's also a lag time quite often, but you had just a period of excessive bullishness from all out crazy Fed gone wild money printing party right there, and then it's starting to unwind now. So that's that. And then the other one I like really, and I like it even more, is the CPCE, the equity only put to call ratio. And so this one I've shared with you quite a bit over the years as well. See this green box here? This is where and since here's where the bull market began back in early 2009, at the very bottom of the chart here, down here. And so this is our big bull market, and again, I consider it, forget about any drops, forget about COVID, they were all part of the same bull market that I believe just ended here. Go down to probably the biggest bull market in history. So these were just, to me, corrections, even though they were bigger than, that one, at least bigger than a 20% drop. That's an old measurement, the 14%. What I was showing you here is, so since this bull market began back in 2009, and it began with a spike to this level. This is fear right here. This is why it's green. It's when you want to buy. Everyone else, it's red when they're buying a lot of puts, a lot more puts than calls, especially on individual stocks, equity only. And you can see it here. There was a double tag of that reading right there. Boom. That's when you wanted to buy. These were, if you bought here, these were the best buying ops. These were after the biggest corrections that we had in the bear market. There was one. There was one. You bought the lows at 2018. You bought the lows in, when COVID hit in 2020. You bought the lows after a year and a half, almost 2 years sideways bear to sideways market down. A lot of indexes dropped 20%. You nailed the bottom of that drop there. Easy stuff. Okay, and that's why unless I see the crowd get scared and start buying, and this one come to an extreme, I'm only looking to trade bear market rallies. And if and when that happens, we get that spike up. All the better if it coincides with my T3 or T4, my next, or especially my final targets on the weekly charts. That's when you want to get long. That's when you want to put your 401k back into equities pretty heavy, and ride the wave. Until then, we have to navigate this bear market, and that's what we'll continue to do. All right, guys, I'm going to wrap it up here, and I'll get to gold and silver in the next update, but I think they still have a chance to rally, and like I said, Treasury bonds are also looking good right now. This has been Randy Finney with Right Side of the Chart. Have a good day.